Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Occidental Petroleum, or OXY.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we really get into it, I just want to remind everyone that the VIP Algos link is below in the description.
Right. Yeah, definitely check that out. It's a fantastic tool for tracking the kind of options momentum we're actually going to be talking about today.
Absolutely.
But okay, let's just jump right in. I want you to imagine for a second that you own a restaurant.
Okay, a restaurant. I'm with you.
And over the past year, you've actually been seating fewer customers. The line out the door is completely gone, and your total sales have dropped by almost 8%.
Which is, I mean, for most business owners, that is a full-blown crisis, right?
Exactly. Shrinking top-line revenue is like the ultimate red flag.
Yeah, usually means you're losing market share or, people just don't like your food anymore.
Right. But then your accountant hands you the year-end report, and you aren't bankrupt at all.
Oh.
Actually, you're looking at profit margins that would make, like, a Silicon Valley software CEO jealous.
Wow, okay.
Your gross profit on every single plate of food you serve is almost 72%. You are just swimming in cash.
On paper, that math really shouldn't work. It sounds like a total paradox.
It does, but we aren't talking about a restaurant today.
No, we are definitely not.
We're talking about Occidental Petroleum, OXY. And today we're figuring out how this heavy industry energy giant with shrinking revenue is somehow triggering a massive tsunami of Wall Street bullishness.
It is a phenomenal case study in wealth building context. Because, when you look under the hood of how a modern company like this actually functions, you realize top-line revenue only tells a tiny fraction of the story.
So is it a value trap disguised by high oil prices, or is it just this masterclass in cash generation?
Well, to really answer that, we have to pull apart that central contradiction with the fundamentals.
Okay, let's unpack this. Because I was looking at the income statement, and the trailing 12-month revenue growth is visibly negative.
Yeah, it's contracted by 7.95%.
But then as you move down the balance sheet, the profitability metrics are just staggering. Net margins are over 23%.
The number that really should jump out about 71.9%.
Almost 72% gross margin.
Yeah.
In an industry that literally pulls heavy liquid out of the dirt.
I know, it's virtually unheard of for heavy industry. And, it supports an earnings per share of $4.70.
While the stock trades at what? A pretty reasonable price to earnings ratio?
Very reasonable. The PE ratio is around 11.11.
I can't get past my restaurant analogy.
Yeah.
They're essentially serving fewer customers, but making significantly more money on every barrel they produce.
Yeah.
How does a legacy oil company achieve tech-level margins like that?
Well, what's fascinating here is that the revenue contraction isn't a symptom of a failing core business. It's actually tied to macro pricing variations.
Yeah.
And some legacy financial contracts, which we will definitely get into. But the reason those margins are astronomically high is driven by scale and geography.
Geography meaning the Permian Basin. Yeah.
Exactly. Specifically, their footprint in the Permian.
I mean, I know the Permian is the crown jewel of American oil, but how does just being located there equate to a 72% margin?
So Occidental has amassed this incredibly scaled, low-cost acreage. In the oil business, your biggest hurdle is the cost to extract each incremental barrel.
Right, the digging and pumping costs.
Yeah. And when you have massive contiguous plots of land, your abstraction costs drop through the floor. Add to that their recent acquisition of Crown Rock, which fundamentally altered their efficiency.
Yeah, I saw people using the word accretive when talking about the Crown Rock deal. But, like, corporate buzzwords aside, how does spending billions of dollars to buy another company actually make OXY more efficient?
That is a great question. Think about it geographically. When you acquire a competitor whose land sits right next to yours, you don't just get their oil.
What else do you get?
You get to share infrastructure. You don't need to build two separate access roads. You don't need duplicate water disposal facilities or, two sets of gathering pipelines.
Oh, I see. You just plug their wells into your existing plumbing.
Precisely. You integrate their assets into your network, which strips out a massive amount of duplicate overhead.
So it's not just adding more oil, it's making the extraction of all the oil cheaper across the board.
It supercharges their capital efficiency.
Wow.
And when you combine that rock bottom extraction cost with the fact that in Q2, their average realized oil price worldwide was incredibly robust.
Like nearly $97 a barrel robust?
Right, $96.78. Your margins are going to explode with prices like that, even if total gross revenue fluctuates a bit.
That paints a really rosy picture, but I have to push back here. Let's talk about the risks in the bear case.
Sure.
If they're realizing almost $97 a barrel and their costs are optimized, why is the revenue contracting at all? Because I looked at their Q2 cash flow and there was a massive hit, like millions of dollars essentially wiped out by something called a collar settlement.
This is where the accounting gets incredibly interesting and where surface-level investors often get spooked away.
So what's actually happening?
Occidental is currently fighting a two-front war against legacy financial anchors. The first is exactly what you mentioned, the hedging hangover.
Right.
In Q2, they suffered a $156 million reduction in operating cash flow due to crude oil collar settlements.
What exactly is a collar settlement? I tried to picture it like locking in a fixed mortgage rate, so you don't get crushed if rates go up. Is that how it works?
The mortgage analogy is close, but a better way to think about it is like a professional athlete's contract.
Okay.
Imagine an athlete negotiating a deal where they are guaranteed a very solid base salary. That protects them if they have a terrible season.
Makes sense.
But in exchange for that security, the team puts a hard cap on their performance bonuses. Even if they break every record in the league, they can't earn past that maximum cap.
Oh, okay. So how does that apply to selling oil?
Years ago, when oil prices were extremely volatile and way lower, Occidental basically bought insurance.
They locked in a floor.
Right. They created these collar contracts guaranteeing they could sell their oil at a certain minimum price, protecting them from a market crash. But the trade-off was capping the maximum price they could get.
So when the market goes on a massive bull run and oil is sitting near $97 a barrel, that insurance policy suddenly becomes a ceiling.
Exactly. They are banging their heads against it. Those hedges force them to sell certain volumes of oil significantly below the current spot price.
Wow. So that gap between the $97 market price and their capped hedge price is what caused that $156 million cash flow reduction.
You got it.
That is a brutal penalty for being cautious. But there's a second front to this war that seems even more bizarre to me.
The natural gas issue?
Yes. The data shows Occidental faced realized natural gas prices of negative 80 cents per MCF.
Yeah.
And for those listening, MCF just stands for 1,000 cubic feet of natural gas. But the price is negative.
Negative $0.8, yeah.
They are literally paying people to take their natural gas away.
Yeah.
How is that a localized problem and not just a terminal flaw in their business model?
It sounds completely absurd to pay someone to take your product.
Yeah.
But it is a very real infrastructural quirk in the Permian Basin right now.
A quirk.
It comes down to geology. When you drill a well in the Permian, you are targeting oil, but natural gas comes up with it as a byproduct. It's called associated gas.
Right. You can't just separate them underground.
No, they come up together.
But if natural gas prices crash below zero, why not just turn off the gas valve?
Because if you shut off the way to stop the gas, you also stop the highly lucrative $97 a barrel oil.
Oh, man.
And you can't safely vent that much gas into the atmosphere due to environmental regulations, and you can't flare it all off either.
So what do you do?
Well, the pipelines in the region that transport gas to broader markets are currently at maximum capacity. There is simply a bottleneck.
So you're trapped. You have this gas coming to the surface, nowhere to put it, and you desperately want to keep pumping the oil.
Right. So you literally have to pay a disposal fee, that negative 80 cents per MCF, just to have someone haul it away or store it.
Just so you can keep extracting the oil that is generating your 72% margins.
Exactly.
That puts the revenue contraction in a totally different light. I mean, the core business isn't shrinking. It's just being temporarily suppressed by a pipeline bottleneck and legacy insurance caps.
Yep.
But are these financial anchors going to drag on the stock forever?
And that is the $156 million question. The critical takeaway here is that both of these issues are finite.
Okay, they're finite.
The collar settlements are legacy contracts. They eventually expire. As they roll off the books, Occidental will be freed up to capture much more of the upside of that spot price.
And what about the gas?
On the gas side, infrastructure eventually catches up. New pipelines are being built to relieve the Permian bottleneck as we speak.
So, assuming these are temporary headwinds, what are the current catalysts? Like, what is management doing with the massive cash flow they're generating right now?
They are aggressively paying down the massive debt they took on from that Crown Rock acquisition.
Deleveraging.
Yes, and this is vital. Deleveraging structurally improves the balance sheet by permanently lowering interest expenses.
Because every dollar of debt they retire is a dollar they don't have to pay interest on next year.
Exactly. It permanently widens the pipe for free cash flow to flow directly to the bottom line or back to shareholders. And they still maintain a very solid $52.6 billion market cap while doing this.
Okay, so if the balance sheet is structurally improving, how is the broader market reacting? We should look at the sentiment and the technicals here.
The sentiment data is practically screaming right now.
Really?
Market sentiment is overwhelmingly bullish. You have major institutions like Evercore ISI Group recently upgrading the stock.
Okay.
But the most compelling metric is the insider buying.
The people who actually run the company, how aggressive are we talking?
Very aggressive. Over the last 90 days, corporate insiders have accumulated a net 68,667 shares.
Wow.
We're seeing 12 buy transactions compared to only 7 sells.
So when the executives who see the daily accounting ledgers are buying the dip with their own capital, it usually signals extreme confidence.
Absolutely.
But the derivatives market is what really caught my eye on the technical side.
Oh yeah, the options data.
Yeah, the data shows the volume of options traded on OXY recently surged to 5.4 times the daily average.
Which is huge.
And the put-call ratio is sitting at 0.07.
That is a staggering anomaly.
For anyone who doesn't track this stuff, a put-call ratio of 0.07 means that for every one bet that the stock is going down, a put, there are roughly 14 bets that the stock is going up.
14 to 1.
It is a tsunami of bullish betting. The stock is currently trading around $52.89. It's up 28.62% year-to-date and up over 8% just in the last 5 days.
Right.
Yet it still remains roughly 21% below its 52-week high of 67.45. And this stock is historically very stable, right? I mean, it has a beta of just 0.187.
Exactly. A beta below 1 means it moves much slower than the broader market. It's a slow, steady, heavy industry giant.
This isn't some highly speculative tech startup. So why are derivative traders piling into short-term call options like it's a meme stock?
Well, this raises a critical point about market mechanics. When you see options volume spike to 5.4 times the average on a low volatility stock, the market isn't just gambling blindly.
What are they doing then?
They are front-running an event. In this case, the consensus points to extremely high confidence in the upcoming Q2 earnings release.
Ah, they're betting the earnings call is going to be a victory lap.
Precisely. Traders see the $97 oil, they know the Crown Rock debt is being paid down, and they are betting management is going to announce synergy realizations that heavily beat expectations.
But is there something else? Because that options volume is so extreme.
There is another deeper layer to this derivative frenzy. The options market is heavily influenced by whispers.
Okay, what kind of whispers?
Unconfirmed speculative market chatter about OXY potentially selling non-core regional assets.
Non-core meaning pieces of the company they don't really need anymore after the Crown Rock merger.
Exactly. They absorbed Crown Rock, integrated the best contiguous land for their Permian scale, and now they might sell off the fringe assets that just don't fit that hyper-efficient model anymore.
And if they do that, they can use that cash injection to accelerate their debt paydown even faster.
Exactly. If management announces an accelerated deleveraging timeline on the next call, it entirely justifies that 0.07 put-call ratio.
That makes perfect sense for a short-term swing trade into earnings.
Mm-hmm.
But, I mean, if you're looking at a longer-term view, holding this stock for 5 or 10 years, a $97 barrel of oil today doesn't protect you from a carbon tax tomorrow.
No, it doesn't.
I want to shift back to the fundamentals and how OXY is future-proofing its moat against the green transition.
It is the existential question for every energy major right now. Oil is a cyclical, politically charged, and highly regulated industry.
You can't just rest on your laurels.
You really can't. You can't hope the regulatory environment stays friendly forever.
And some market participants are already sounding the alarm on OXY's valuation.
Right.
The data shows they are trading at a price-to-sales ratio of 2.63.
Yep.
Which is considered a premium valuation compared to some of their pure-play drilling peers. Now, the company is actively developing something called OXY Low Carbon Ventures, and they possess major enhanced oil recovery capabilities, or EOR.
Which is huge for them.
But I have to play devil's advocate here. Are investors really willing to pay a premium valuation of 2.63 times sales just because an oil company is dabbling in green projects? Like it feels a bit like a PR stunt, doesn't it?
Greenwashing to appease regulators.
Yeah,
That
exactly.
is the common misconception. But enhanced oil recovery is not a PR stunt. It is a structural cost advantage. And first off, that 2.63 price to sales ratio is easily defended by their near 72% gross margin.
Because a single dollar of sales for OXY generates vastly more actual profit than a dollar of sales for a competitor.
Exactly. But your point about the low carbon ventures and EOR is crucial to the long-term view.
So how does a low-carbon initiative actually make them better at producing oil?
Let's break down the physical mechanism of EOR. When a traditional oil well gets older, the natural pressure drops,
Okay.
and it becomes very difficult to get the remaining oil out of the porous rock. EOR involves capturing carbon dioxide, literally pulling it from the atmosphere or from industrial emissions,
Right.
and pumping it deep underground into these mature, depleting wells.
Okay, so they're burying the carbon.
They are marrying it, but it serves a dual purpose. When the CO2 mixes with the trapped crude oil, it actually changes the oil's viscosity.
Oh, wow.
It makes the oil swell and flow much more easily, forcing it to the surface.
Wait, so they are using the captured carbon to literally squeeze more product out of legacy wells?
Yes, it's a technology that extracts highly profitable oil from old assets that competitors would have just abandoned, while simultaneously permanently sequestering carbon underground.
That is brilliant. It's not greenwashing, it's a highly efficient extraction technique that just happens to be environmentally beneficial.
Exactly. And at the same time, it entirely future-proofs the company against regulatory shifts.
Because if carbon taxes become a reality or emission caps tighten significantly globally, Occidental already has the physical infrastructure built to sequester carbon at an industrial scale.
In fact, they could potentially operate as a carbon sink for other industries, charging a fee to bury their emissions.
That puts them leaps and bounds ahead of pure-play peers who are just pumping and selling, hoping the laws don't change.
Precisely. Other oil companies lack the balance sheet depth or the technological head start to innovate like this.
And OXY is doing all this while maintaining their distribution, paying down massive acquisition debt, and sustaining 72% margins.
That is why they command a premium. The market is pricing in a company that is actively ensuring it won't be regulated out of existence in 10 years. Plus, they're even being included in dividend contender watch lists.
So pulling all these threads together for our final verdict, we started with the paradox of shrinking revenue, but massive margins. We looked at the pipeline bottlenecks, the hedging constraints, and the massive derivatives frenzy.
Yeah, a lot of moving parts.
What is the final investment rating on Occidental Petroleum?
Synthesizing everything we've looked at, the stock earns an 8 out of 10 bullish score.
8 out of 10 is a very heavy conviction rating.
It is. It presents a deeply compelling value play. It's a cash-generating machine with clear, identifiable catalysts on the immediate horizon.
And we want to be clear, we are not telling you to buy, sell, or hold this stock. We're just laying out the analysis.
Exactly. You have to weigh the upside and downside yourself. On the upside, it's positioned as viable for two very different strategies.
Right.
First, you could look at it as a short-term swing trade into the upcoming Q2 earnings, capitalizing on that options momentum and the potential for a debt reduction surprise.
Riding the wave of that wild 0.07 put-call ratio.
Exactly. Or, looking at the long-term view, it is a multi-year hold, entirely contingent upon confirmation of their debt paydown.
Because if management proves they are deleveraging as aggressively as they claim, the enterprise risk dropped significantly, and their free cash flow will absolutely surge.
But on the downside, you still have to watch those legacy hedges and the negative natural gas pricing until those bottlenecks actually clear.
Right. It seemed like a rare situation where the technical momentum, the insider buying, the options volume, perfectly aligns with the fundamental story of debt reduction and margin expansion.
Usually you have a fundamentally great company with a terrible stagnant chart, or a terrible company with a great momentum-driven chart.
But OXY has both right now.
Occidental currently has both the fundamental and technical winds working in its favor.
Which leaves you, the listener, with a final, lingering question to mull over. We spent a lot of time talking about those massive financial anchors earlier.
The legacy hedges that cap their upside.
And the pipeline bottlenecks that cause negative natural gas pricing.
That brutal $156 million cash flow hit in a single quarter.
Right. So think about this. If Occidental Petroleum is already managing to generate 71.9% gross margins while being actively penalized by millions of dollars in legacy hedges, and while literally paying people to take their natural gas away.
Yeah.
What happens to this cash machine when those legacy hedges finally expire, the pipelines open up, and they are fully unleashed in a $90 plus oil market?
It's a powerful thought to leave on.
Keep a close eye on those upcoming earnings. As a quick subscribe reminder, if you found our analysis helpful today, please subscribe, like, and comment underneath.
And don't forget to click the VIP Algos link below in the description to help you track market sentiment and unusual options activity, just like we saw with OXY today.
Thanks for joining us for this analysis on the energy sector. We'll catch you on the next one.